Well, it was a fresh all-time high for the Australian ex-share this Tuesday, but what's driving it and will it continue? Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 3rd of December 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So overall, our market has largely followed the US market this year, and the US market indeed mostly set fresh highs overnight. We saw the S&P 500 and the Nasdaq reach fresh all-time highs. A bit of a laggard was the Dow Jones, which doesn't have as many high-growth technology stocks, and so outside of those technology stocks, it wasn't the strongest session for US markets. That wasn't enough to disrupt our own upwards movement, however, and I think we played a little bit of catch-up given that the US broke into fresh all-time highs late last week in their shortened Friday session. So it's the US strength largely driving it, and indeed it's actually driving strength all around the world. We saw fresh all-time highs or fresh highs reached in the Eurozone overnight, for example, and that's despite signs that the French government might be on the verge of breaking down. As has been the case for most of this year, and particularly over the last few months, it seems that the strength is mostly coming from essentially stimulatory US fiscal conditions, with the US government deficit now around 7% of their GDP. And also, we're seeing the interest rate cuts from the Federal Reserve. So they cut in December, they cut again last month, they cut in September, they cut again last month, and there's debate about whether they'll cut again this month. Those interest rate cuts and the huge amounts of fiscal spending are essentially usually settings we'd see to try and stimulate an economy recovering from a recession, for example. This time around, it seems like they're trying to front-run the recession, and in doing so, they've achieved, continued economic growth, but they haven't seen inflation continue to fall back towards the target range. So US inflation remains sticky. It's barely moved for the past few months, and if that continues to be the case, it looks like we're going to see less rate cuts next year. Regardless though, markets are happy to buy up at the moment with the belief that eventually that inflation will come back down of its own accord. Again, I'm not convinced by this, but it doesn't matter in the short term because it's enough to keep markets powering higher. For our own market, we've seen some pretty mixed economic data, and again, it doesn't seem like we've cared too much about this. We've more sort of followed the US overall movements. We saw underlying inflation come in at about 3.5% for the month, and that was up from 3.2% the month before. Now, more dovish people will point to the headline numbers, but if you remove some volatile items and the energy rebates and things like that, inflation has started to push back up and is remaining above target range. It is for that reason that the RBA has been stating that they don't expect to see underlying inflation return to the target range until 2026, for over a year's time. It doesn't mean they're going to wait until 2026 to cut interest rates, but it does mean that, we're probably going to see less rate cuts next year from our Reserve Bank than we initially expected. So originally everyone was expecting rate cuts this year. Most recently it was expected around February next year, but now it seems like the expectations are being pushed out until May next year. The next important data reading for our market will come with GDP tomorrow, 11:30 a.m. Australian Eastern Standard Time. GDP growth is expected to come in at 1.1% year on year, well below historical averages, well below trend, and pretty much below population growth. So on a per capita basis, our economy is actually getting smaller. Not a great sign, but again, I'm not sure it's going to be enough to force the RBA's hand to cause them to cut rates earlier than expected. They don't want a scenario where, inflation's remaining strong, yet the economy continues to weaken. So we're going to have to watch that one closely. I wouldn't be surprised to see GDP growth come in worse than expected, and that's because today's net export contribution to GDP was lower than expected, and as a result, tomorrow's numbers might be a little bit weaker. Bit hard to say though, so we'll have to wait for those numbers. It does come as a little bit of a surprise that our market's making fresh highs, while our economy is particularly, underwhelming. But like I said at the start, it really doesn't quite matter as long as global markets are following US markets, and as long as those stimulatory economic settings are in place, all that additional money that they're creating is essentially flowing to the stock markets. Finally, I wanted to touch on iron ore. I think that's one sort of bright spot for our market at the moment. The iron ore miners are well below their October and even early November peaks, and yet iron ore is actually powered to the highs that it achieved in October. Given that's the case, we do see potential for upside in the iron ore miners. Like I said, they've lagged that iron ore price. Given there's so much bullish momentum in global markets and the iron ore price is pushing higher, you would assume that eventually they're going to join in the optimism. It's one to watch. Again today, they actually ended up closing slightly lower, at least BHP and Rio Tinto did, and despite the continued strength in iron ore. One to watch though, if our market does have much further gains from here, you have to assume those large miners are going to join in the party as well. So let's have a look at the charts for this week, guys. And this is the Australian XJO index, the top 200 stocks by market capitalization. And this is the all-time high we reached today. We broke above the resistance at 84.50. We'd held that for the past week or so, and we rose to 8,500. It's pretty typical of our market to move up and down in 50-point increments. Before we were sort of sticky around 8,400, then 8,450. Now we're at 8,500. We're going to have to wait and see if this proves to be a bit of a resistance level or not, and whether or not we sort of push higher from here or fall down from here. If we do fall from here, it's a bit hard to say where we may move to, but the previous high at 84.50 is likely to be the first level targeted to the downside. If that breaks, we could see a move all the way back off towards 83.50 or so levels that we saw around the middle of November. Regardless though, we are in an overall upwards movement in both the short and longer terms, and so you have to assume further upside until we see some of these trend lines break. We are overbought, but any sort of bearish movement seems to be bought back up pretty quickly at the moment. Let's have a look at the US charts for this week. And this is the US S&P 500. So on Friday last week, they did reach a fresh all-time high. They broke above their 6,000 point level on the S&P 500, and overnight they saw a modest additional gain. Given that they've now broken that 6,000 level, that's likely to act as support against any downside movement. If they do break back below that level though, we could expect a move back towards that medium-term trend line, and that might put them around sort of 5,900, 5,950, depending on when they reach it. Markets do look stretched up here, and indeed the US market looks a bit overbought in the short term as well, but it doesn't have that sort of potential bearish driver to cause a bit of profit taking. We've seen some negative news. It wasn't enough to turn things around, and it's a pretty quiet week, at least for the next few days for US shares, so it's a bit hard to see where some negative selling pressure might come from. So we'll wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click subscribe. It's free and it helps us out a lot. We'll see you next time.